It's showtime. Welcome to the House of AC. So excited for you to join me today, whether you're watching live or tuning in later, watching this on YouTube or the House of AC Facebook page. This is also live streaming on Twitch and Twitter and Discord, just so you have no excuse for missing this show every day. I do this every day for you, and I don't want any excuse that you don't have YouTube access, you don't have Facebook access at work, you don't know what Discord is. Twitch is what my kids do. Twitter is, oh, you're on Twitter. Good, because I'm live streaming on Twitter as well. All these things for you. So thank you for tuning in. This is the House of AC. We take some of the clips of these, we put them on TikTok, we put them on Instagram. Maybe you've seen those and that's why you're joining. Or maybe you want to go watch those. Follow the House of AC, right there on the screen at the House of AC. That's me. Now, if you Google the House of AC, you're going to learn a lot about air conditionings, and that has nothing to do with me. So possibly this was poor branding, but I'm in too deep. So you just got to roll with me. All right. This is the House of AC. And we have a fun show today. Fun and educational, because these are the most common objections I get to real estate investing. Okay. This is a common denial of why you can't real estate invest. I get this all the time. Houses are too expensive in my area. I don't want to be a landlord. I don't want to get phone calls at 3:00 in the morning. But guess what? No one does. And it's always expensive where you live. And there's people who have solved this. And our guest today, Eric Hughes from Rental Income Advisors, is amazing. He teaches this. He does this. And also I do this. So you're going to listen to two people talking about how to invest long distance, completely hands off. Also, here's the other thing. Things are too expensive. No way. And I say, just buy a house that's under $100,000. And no one believes me that there's homes out there under $100,000. Just because it's not on your block, just because it's not on your street, just because it's not in your zip code doesn't mean it doesn't exist. I've bought over 50 homes under $100,000. Eric currently has over close to 20 homes around under $100,000 in a different state that he bought before he had even visited. Okay, this can be done. It's achievable. That's why I wanted to bring Eric on today. He's amazing, and we're going to teach you how to long distance invest without all the headaches, without even buying a plane ticket to go somewhere. And we're going to teach you that there's properties out there that are under $100,000. So great episode today. Let's give a nice round of applause to Eric Hughes from Rental Income Advisors. Thank you for joining us, Eric.
Hey, Alan. Thanks for having me.
Now, you probably heard that intro. I was lying through my teeth, all that, wasn't I?
Well, it sounded good to me.
So yes, validate my claim. You can invest in properties under 100K in a different state without even having to go to that state. Is that an accurate statement? Because I just want to know for sure.
It's an accurate statement. Describes what I did, and it describes what I work with my private coaching clients. It is a leap of faith for people to say, I want to invest someplace where I don't know. And also people don't realize what homes actually cost in lower cost of living markets. They're a lot cheaper than where you might be living.
So quick rundown, where do you live right now?
I live in New York City and now also Florida. So I'm standing in a condo that we just bought.
Okay, so you did disclose that you just moved to Florida and your internet is not perfect. So you are breaking up a little bit, but I'll fill in the gaps here. You live in New York, you snowbird in Florida. You are able to fund this dream, this dream lifestyle. Who doesn't want to live in two different places, and then winter and summer, and that's fun talk for me. You help achieve this lifestyle through your rental investing. How many properties do you own that are not in New York City and or New York State and not in Florida?
20. Yeah, so you had that right. So we've got 20 properties.
20 properties. So and what was the price range of these 20 properties?
Anywhere from $50,000 to $130,000 at the time I bought.
$50,000 to $120,000. So people out there are probably scratching their head. They had no idea that these properties were $50,000. Now, this is probably in the middle of a desert or in North Pole. Like, where are you finding these $50,000 to $130,000 homes that you're able to acquire 20 of them?
So my properties are in the Memphis area, Memphis, Tennessee.
Okay, so that's a legit city. They've got a professional basketball team. It's a growing city. FedEx is headquartered there. Wow, I was expecting this to be in the middle of nowhere. So Memphis. Okay, so Memphis, Tennessee. So just now I feel like everyone's level set. 20 homes in Memphis, Tennessee. Eric's done this snowbirding to Florida or being in New York City. Real quick, I did a similar sort of process. I've owned 50 homes about an hour and a half from me, and I bought 30 of them before I had even visited the town. How often did you visit Memphis, Tennessee before you bought your first property?
0 times. So yeah, I bought the first 2 before I went. I've only been once ever, and that was mainly just to drive around for a day and meet some of my partners on the ground in person. I haven't been back since. I don't have any plans of going back.
I love this. I love this. And then I know you now run a successful coaching program teaching other people how to do this. What would you say is roughly the number of people you've helped also buy property long distance and sort of in the same low price point?
Yeah, quite a few. So just last year, I helped over 15 clients purchase over 50 homes.
Wow.
And the
Wow.
same
Okay.
model. Yep.
Okay, great. So this is amazing. And I'm going to put up your website real quick. Plug your website. There's Eric's website, Rental Income Advisors. And if you want, I completely endorse Eric. All right. So if you trust my advice, just extend that trust to Eric and what he does. He's knows what he's doing. I know what he's doing because he's so transparent on his website. You can actually go to his blog, and it'll tell you the pros and cons of what he's making every single month on his properties. And Eric, I love this because I can go in and you're not saying you made $1 million every month. You're saying, hey, this month I lost money because of XYZ, and this month I made money because of XYZ.
Yeah.
Do you mind maybe walking through us a bit of what recently, I guess your most recent one in December here?
Yeah, sure. So yeah, I publish a portfolio update every month and then an annual report at the end of the year as well, just for transparency and so that people can get a real sense of what it's like to be an investor in this model. So yeah, so I've got 20 doors, 19 were occupied in December. So we had a couple of turns that were just completed. So pretty much getting back to full occupancy. So I'd walk through that and then, walk through collections. So I've got one non-paying tenant right now. So dealing with that through an eviction. So that'll probably be a couple more months before I can get that property back and rented. And that happens from time to time. With 20 properties, you might have one eviction a year, right? So it's just part of the business.
So how involved are you in the eviction process? Are they calling you and you're going to have to call the governor or the city sheriff to throw their stuff out and go to the court? Like you own a property in another state, you have to do an eviction. How involved are you?
Not at all. So I work with a professional property manager, which is key to this sort of investing model, and they handle everything. So they've got a lawyer on staff who pushes all their evictions through the court, and I'm not involved at all.
Okay, and then so you are involved in the toilet breaking at 3 o'clock in the morning. They do call you for that, right?
Yeah, no, they don't. They don't call me for anything.
Okay, so
yeah.
When do they call you?
I mean, pretty much never. They know what they're doing. They handle all of the functions of the property once I buy it. There is no task that I am responsible for. So from maintenance, dealing with tenants, screening and placing tenants, responding to maintenance calls, evictions, Section 8, you name it. They do all of that. So I kind of just stay in touch via email if I have any questions, or if there's a large issue, they will get in touch with me to discuss that. But other than that, they do the work every day.
Okay, so I love this. Because I share similar stories, and people just don't think that you can buy a property that's worth buying for under $100,000. Roughly, let's say you buy a property for $75,000. What would in Memphis, Tennessee? What sort of rent can you expect for a home of that price?
Yeah, so a house 75,000, assuming you buy it in good condition, right? So it's a rentable house at 75,000, that sort of a home. Yeah, you're going to be able to rent that for between 750 and 900, depending on the home and the neighborhood.
Okay. Wow. So that's great. And so there's something out there called the 1% rule, which seems very achievable and unachievable, I should say, in most markets. And it's just a rule of thumb. It doesn't always work. And it really is just a back of the envelope sort of metric. And what that says is 1% of the purchase price, let's say a $75,000 home, 1% is $750. If you can get that in rent, most cases, high probability it's going to make money. It's going to be a profitable investment. So that doesn't happen in my city, right, in urban Atlanta. It doesn't happen in New York City. It doesn't happen in San Francisco. But smaller tier cities, you can find that. I found it an hour and a half outside of Atlanta and more of the suburban areas. So it's a good metric for cash flow. Maybe you're buying a house for $75,000 in Memphis, Tennessee. The expectation is not that that's going to turn into a $500,000 house in 2 years. It may, that's appreciation investing, but what you're investing in is that slow, steady paycheck. You're going to make $200. What do you roughly make per home? $200, $300 cash flow at the end of the day?
Yeah, that's about right. So, that $75,000 home, if I put, 20,000 into it, maybe 25, I generally try to get at least 10% cash on cash. So that turns into 2,500 a year, right? So that's 10% of the 25,000 that I put into the property. So yeah, that's about 200 a month on that home in an average year, right? Remember, there's a lot of variation in one home year to year.
Right. And so when you say put 25,000 into it, is that the purchase or is that a renovation or where's that $25,000 going into?
Yeah, for most of my homes, it's just the down payment and the closing costs because I'm not doing an initial rehab most of the time.
Okay. So yeah, that's important that you can get a home, $75,000 and doesn't need work. Like it's some people think automatically anything under $100,000, that's going to take all their money, 20% down, 25% down. Then I don't have money for repairs. But this product exists in livable homes in nice neighborhoods, in towns that you've never been in towns people are proud to live in, and they'll raise their family in these homes, and then their kids need a house. And there's communities out there that maybe you are not familiar with because you didn't get raised in that town or that type of living situation. But there's great people there, right? There's great tenants at every price point, great homes at every price point. It's just sort of taking off the lens, the sunglasses that say, like a lot of new investors say, I wouldn't want to live there, so I don't want to buy the house.
Right.
And that's tough because if you're going to only buy properties you want to live in, there's most likely not going to be much cash flow because it's, you're paying for that taste, you're paying for that prestige, and that doesn't pay very well, honestly.
Yeah. And a lot of my clients, have that mental hurdle to say like, is that really an asset worth owning? Because I wouldn't want to live there, right? It doesn't have, that great curb appeal or the nice, interior kitchens and all of that, or it's in a neighborhood that maybe isn't the best. And yeah, so the answer is, well, you don't have to live there. And yes, it is worth owning because it's an asset that produces cash, right? It's a high yielding asset to own, even if the price never goes up, and that's what I tell folks. I don't care what happens to the price of my homes. It makes zero difference to me. Up, down, same, doesn't matter, right? I just own it for the cash flow. And that's what allows me to not be in the office anymore.
Yeah, I love that. I mean, this is what you do full time?
Well, yeah, now I, since I left work, I now have the blog and the coaching business, so that takes up most of my time. But then I also work part-time as a bookkeeper for a few small businesses, which I can do on my own time from home. So yeah, between those things, it fills up most of the day.
Yeah, that's awesome. This is true. I teach house fire, being financially independent and retiring early through houses. I think we see very similar. We see eye to eye. You give your seal of approval on my book. You helped me edit. Thank you for that.
Yeah.
You're someone I trust and I've been following for a long time. And I just wanted to fact check everything. I don't want to be that person, saying this is my experience. Is it only unique to me? And to see that you have the same experience, it's just been wonderful. And again, this is Rental Income Advisors. Guys, if this is something you're interested in, Eric is going to hold your hand every step of the way. Can you kind of walk us through that process? What do you suggest is like step one? Someone who's never been a real estate investor, they've maybe got $30,000 saved up, but they want to diversify out of stocks, or they want this life of leaving their day job so that they can be a full-time real estate investor remotely. Where does someone even begin for something like this?
Yeah, I mean, the best place to start is through education, right? Learning from people like you who are putting great content out there to really understand the model and how it's going to work. So that's the first thing. A lot of the folks that I work with have done that, right? So they're plugged in, they're reading, they're learning, but maybe they just haven't been able to pull the trigger. And that, I think, is one of the hardest things, because there is so much out there that sometimes it's hard to understand what's real, what's not real, and what strategy is going to be the one that works for me. If you've got 30 grand saved up, that's enough for your first home in a remote market at these price points. So it's a great way to sort of get your feet wet and understand how it's all going to work. One thing I do tell people, though, and remind people is, with one home, there's a lot of variation, right? So you could, buy a home and then 2 months later have an eviction, right? You could have a big maintenance expense. Those are things that are all part of the business. And owning one home, it's a little risky because you may get unlucky and then say, this doesn't work, right? This model doesn't work. So it really starts to work and be valuable, particularly as a way to replace W-2 income once you start to scale, right? So getting 5 or more properties, that's when you really start to get significant cash flow and a little more predictability in what's going on month to month and year to year.
I love that you say that, because a lot of people want to buy the one house in all cash. And to me, that is the riskiest move you could do. Let's assume $100,000 price point. You're lucky enough to have saved, be in position to have $100,000 in savings. People want to go buy a house for $100,000. What you just said, what I just heard is, no, why don't you buy 5 homes with 20% down on each house, so $20,000, and you've got 5 homes that have a mortgage. It's actually less risky, because when you do have those vacancies, you have 4 homes floating that 5th vacancy. If you have a major repair, you have 4 other cash flows that is going to help on that 5th home repair. Is that sort of what you're seeing? The scaling sort of reduces the risk?
Definitely. Yep. Scale and time, right? Those are the things that are going to reduce your variation, right? And it's going to get you closer to what your projected returns are. So, it's just like batting average, right? You can't judge a hitter based on one at bat. You got to take enough swings, enough at bats to sort of get to that average. And and the nice thing is that, with mortgage rates have ticked up a little bit, but they're still historically low. And it's an amazing, powerful tool to increase your returns. It's just a regular old 30-year fixed mortgage, nothing fancy, no creative financing. But you can increase your rate of cash return by using a mortgage, which is sort of counterintuitive, right? It's like, but in your example is the perfect one, Alan, right? So if I buy 4 or 5 homes leveraged with a mortgage, I might make 12% cash on cash on my money invested versus only 7 or 8 if I just bought that one home in cash. So plus, well, then over time you get your mortgage pay down, you get appreciation on all 5 of those homes over the long run. So it really juices your returns in a big way.
Yeah, I love that. And the reason why the returns are better, if you're just new to real estate investing, is you're putting less money in. Putting $100,000 and getting a return, you can get basically double that by putting $20,000 and getting it's a smaller return, but you've also put much smaller, fewer dollars, smaller amount of money into it. So it's all about scale. It's all about leverage. That's the key to real estate. And what we mean by that is using other people's money, the bank, to help you leverage. That's leverage. Borrowing money is leveraging those opportunities, and scaling is trying to buy as many as you can. I would imagine that this sort of process starts with finding a good, well, first identifying what town and city you want to invest in. So where would you say to look? Is this something that you coach them on, or is this something that maybe they've got their eyes and ears on a local community, and then you help them from there?
Yeah, I help them through a market selection process. So, and that's what I would advise people to do, is to think about what you're trying to get out of your investments and then find a market that's going to support that. So for me, I'm a cash flow investor, right? I don't care what happens to the home prices. I just want a high rate of return. So that pushes you into low cost of living markets. And I do have a blog post that goes into detail on 12 pretty good cash flow markets that you might choose from if that's the type of investing that you want to do. But generally, it's going to be not in the big name cities, not in the hot markets that you hear about, because in those places, the homes are too expensive to make strong cash flow. So it's going to be in your sort of second tier, third tier cities, and some markets, Memphis, Tennessee. It's a great place. I like the town, but it's not Nashville, right? Which is 2 hours away. It's a totally different kind of a place. So, again, whether you would want to live in these particular markets is not really the point. The question is, where do you want to invest your money? And the biggest factor to think about there is just the prices in the market and the rents that you can get for the homes, right? That ratio, what we call the price to rent ratio. That's the biggest thing that's going to determine how much cash flow you can make, how many opportunities there will be for good cash flowing properties in a given market. So that's the biggest thing to look at. But there's some other factors as well.
Yeah. So, okay, once someone identifies a city and they like the price point, the rent to price ratio, if it meets that 1% or better, that's amazing. And don't just say no to a deal if it doesn't reach the 1% rule. This is just sort of back of the envelope sort of situation. And those watching right now, feel free to ask questions. If this is something you're interested, we want to hear from you right now on the live stream, what your questions are. But you've identified the city. What is the next step? If you say, hey, I'm going all in on Memphis, what does it start with a real estate agent? Does it start with a property manager? How do you sort of vet that team, those boots on the ground for you?
Yeah. Once you know where you're going to be, then I think there's two real steps. One is to try to build your team on the ground. So two most important ones that you already mentioned, right? It's an agent and a property manager. So finding the right property manager is super critical. So this model works really well if you've got a professional PM who's capable. It doesn't work well if you don't. So it's pretty much, a linchpin in the whole model. And then your agent is going to help you to source properties, although you're going to probably do a lot of that on your own, but can also just help when you're ready to make an offer. They're your voice. They do all the paperwork for you and just, make it an easy process. You don't have to do that on your own. And of course, both your agent and your PM can help you learn a little bit more about the market at the neighborhood and zip code level. But you're going to want to do your own research on that as well, so that you've got a strategy of which neighborhoods and which types of properties I'm going to be going after.
So PM's property manager, if you guys are just tuning in. And I sort of got the double golden goose. My real estate agent is my property manager. So he's motivated to both find me new deals and properties. And he happens to also manage about 300 other properties. So whenever those properties are being sold, who do you think the first person is that he calls to see if they want to be bought? I've gotten so many off-market deals because this person just keeps it in-house. I've got investors selling 5 homes. Alan, you want to buy them? No. Do you have any clients that want to buy them? Yes, kind of thing. So definitely that's sort of the situation that I like to create. And the more you do this, the better those deals kind of come on. And if you're thinking about doing this, just a quick plug, a sponsor of the show is Jasmine Home Lending, jasmineteam.com. I'm a partner there. She's funded all these deals that I do. So I personally have used jasmineteam.com. So check it out, get pre-approved there. And, then I would imagine that's how you identify what you can afford. And then you sort of call in to, like, how do you know what's a good real estate agent? How do you know what's a good property manager? is there questions or a procedure, or are you just sort of winging it from Yelp reviews? Because I'll tell you this, every single property manager in the world has terrible Yelp reviews. They're all 2 stars. The reason for that is the only people leaving property managers Yelp reviews or Google online reviews are tenants that get evicted. So they're actually doing a good job. They're doing it on their behalf. The angry tenants will leave bad property reviews. There's very few landlords who actually go on and leave reviews for property managers. So that is why you can't just go by online reviews by themselves. But how do you source and vet your property manager and your realtor?
Yeah, your realtor is, I would say, less important, right? So for me, my agent sends me listings, so that helps. Key off-market deals, which is nice, but mostly it's just administrative, right? Here's the house, here's the offer, send it in. What did they say in the offer? And then the due diligence period, which is sort of the period between when you go into contract and when you close, right? So they're a big help there. The much bigger choice, or the more important choice, is who your PM property manager is going to be. And it's so important that I built a free tool that you can download on the website, which is a vetting checklist for property managers. Yeah, if you just go into free tools there, a vetting checklist. So this gives you, I think, like 50 or 60 questions that you can ask a property manager when you interview them, because that's you're going to want to have about an hour with 2 or 3 different property managers in your market and ask them all these questions. So you want to understand how they operate, how mature and professional are they as a business, what their fees are, how they place tenants, right? All those important functions that you're going to be relying on. So this is really helpful. You don't want to just get on the phone and say, well, did I like the person I spoke to? There's more meat that you want to understand about how their business runs.
And so what did the property manager roughly charge?
So I pay 8%. Well, there's two main fees that most property managers charge. One is a percent of rent collected, and the second is a leasing fee whenever they have to place a new tenant. So typical percentages for rent collected is between 8 and 10%. I personally pay 8%. And the leasing fee is generally anywhere from 1/2 of a month's rent up to 1 full month of rent. So those are the typical.
This goes with scaling too. Property managers typically will start at 10% if they're just managing one house, at least from my experience. But once you get 5, 6, 10, 20 homes like yourself, it's much easier to now negotiate an 8% property management fee.
Yeah, that's common. Yeah, that happens a lot. Yeah.
So that's all about scaling. You get cheaper services and vendors. We've got a question from Real Estate Jojo. Are these homes rent ready, or do you need to put money into the rehabs? Jojo finds it hard to find homes under 100K that allow for financing rather than all cash purchases and rehabs.
Yeah, it's a great question. So there's really 2 things in there. One is, are these rent ready homes? Yes, right, for the most part, right? So, again, the neighborhoods I shop in today, prices today are probably, call it 80 to 120, right? 130. That's the mid-range for these sorts of homes. And it's like essentially a cookie cutter 3-bedroom, 1-bath or 3-bedroom, 2-bath home. It's not fancy, right? So, but it's a house, right, that somebody's going to live in and pay rent. So no, yeah, I generally don't do rehabs. If you were to buy rehab properties in these same neighborhoods, they would be $25,000 or $30,000, right? And then you would put in another 20 to 30K to get it into rent ready condition. So, but there is an issue with small mortgages because not all, and this sort of sounds like what the question was getting at, I think. Some lenders will not give you a mortgage under a certain amount, but some will. So you just have to find a lender who has a program where they're willing to work with you on smaller mortgages.
Yeah, lenders are always changing their offerings and their programs. The reason why a lot of lenders will tell you they don't want to lend for under $100,000, it's actually a good thing. There's something called the Dodd-Frank Act. And this was instituted after the last real estate crash, finance in 2008, where basically anyone willy-nilly could get a loan. They did pass a law that a certain percentage of the fees on a loan could not be more than the loan amount. So I forget what the number is. 7% of the fees to get a mortgage cannot be higher than amount, something like that. And so if you have a really, really low balance, you can only have certain, size of fees. Like you still have to pay the closing attorney, the mortgage company's got to make some money. And so it's a way, theoretically, people don't get ripped off by huge fees on a mortgage. So a lot of them, like they just can't whittle away the fees on things more than $100,000. But
Yeah.
there are people attracting, all sorts of new investors out there. But what are you looking at for a rental house out of state? Is this a 20% down payment, 25? What's the average?
Yeah, so you'll have to pay 20% as a minimum on an investment property loan. Some lenders will give you a slightly better rate if you go up to 25%. So that's typically what I'm doing, what my clients are doing is 20 or 25% down.
Okay. So you get your pre-qualification letter, you find your realtor, you go through the free property manager vetting checklist on your website, rentalincomeadvisors.com, and then you're ready to buy homes. And so this to me is where a lot of new investors kind of get, the deer in headlights look. Their realtor that they found, that they trust, that's been recommended or vetted through your coaching program as well. They get presented 3 or 4 homes and they all are profitable. And it's like, which one do I make? Do I buy a plane ticket? I can't believe I'm buying sight unseen, a house across the country. How do you get people over that sort of mental hump?
Yeah, I think it's through looking at the house through a different lens, right? Again, you're looking at it, when you buy a house for yourself, there's a lot of little details that you're going to care about. So you want to get that walkthrough. So that's what people are used to. They're used to like, I want to kick the tires here. I want to, see what the door handles feel like, or, little things that are going to make a difference because you live in the home. For a cash flowing rental property, you just don't care about any of those things, right? You care about the price and the condition of the home, which you can learn through photos and a home inspection, which you're always going to do. And you care about how much you can rent it for. And these are all things that you can learn from afar, right? You don't have to be close. You can even walk the streets virtually using Google Street View, right? If you want to get a sense of the neighborhood. So there's a lot of things that you can do remotely that make it totally unnecessary in my mind to like be where you are investing.
Yeah, and so this is why when I compare it to this, like if you're going to live in the home, that's a lifestyle decision. If you're going to invest in the home, it's a spreadsheet decision. You just pick exactly what has the best number in a spreadsheet, right? You don't care, if the closets are too big or not, because that's maybe something that throughout your lifestyle, because you are a sneakerhead or whatever it is. But your tenants, there's going to be a tenant who doesn't care about the size of the closets, or that the size of the closets that the house have is bigger than the house that they're coming from, or it's the standard, like that's just the houses on that whole block probably have the exact same size closets because they were all built at the same time, and that's their expectation. So again, you got to take your mental lifestyle investing hat off because this is a spreadsheet decision. You plug in the numbers. So when a realtor sends you 5 items, you just plug in the 5 different homes into a spreadsheet. Which one has the biggest, juice on it? What is it? The whatever squeezes most juice out of it. The cash flow. And so it's difficult at first. I understand that. It feels really, really scary. But this is the other way I like to mentally gymnastics my way around it. If you are getting a mortgage on this, which we both have recommended in the show so far, it's best for your returns. It's best for your money. It reduces risk. Think of it this way. The most stodgy, conservative business partner you'll ever have is a bank. The bank is not going to give you money unless they think this is a good deal. And so because the bank's going to underwrite the deal, they're going to underwrite you. They're going to send an appraiser out there. The appraiser is going to determine what the rental income value of the neighborhood is. And if the most conservative institution in the world is saying, yeah, I'll give you 75 to 80% of the money to buy this house, boom, that's a huge win to say, okay, if a bank thinks this is good, then of course it's good. Because otherwise, if a bank thinks there's even a chance this is going to fall under or you're going to default on the loan, they're not going to give you money. They're not in the landlord business. They don't want to be. They're in the money lending. They're in the conservative money lending business. That's sort of that's sometimes how I phrase it as well.
Yeah, I think that's all correct. I've had a few homes, that don't appraise, for myself or for clients, and that's an indication that, okay, the bank doesn't think it's worth this much, or there's an issue that has to be fixed before they can do that. So yeah, getting the appraisal is just one more sort of security blanket that tells you, okay, this is what the house is worth, and that it's going to cash flow.
So yeah, and so here's all your check marks. So that was good. The appraisal's a security blanket. You have a spreadsheet of 4 or 5 homes that are probably similarly priced in the same neighborhood that all have similar rental income. So that's sort of a good gut check on things. You have a real estate agent. If it's one that's authentic and honest and genuine, they're going to tell you when it's a bad deal. They're going to tell you when it's a good deal. They're the eyes and ears that are local. That's another person who's going to vouch for you. Also, the property manager. A property manager, if you get a property manager on board, prior to you closing on the home, and they say, no way in hell am I going to manage that property, then that's also a good indicator. So you have all these sort of experts sort of weighing in, checking in your bank, all this stuff, telling you whether this is safe or not, whether this is going to be, worth it, and all those things. And think of it this way: you're only putting, I like to use $100,000 purchase price of a house. You're putting 20% down, $20,000. Now, let's assume worst case scenario, 15 minutes after closing, the house burns to the ground, and you're out of luck. Well, you still have safety nets. First of all, the land is most likely going to be worth 20% of that. So you at least have an empty lot now that's $20,000. And that's why the bank wants you to put at least $20,000 down. And so there you go. You haven't lost any money. If you put $20,000 in the stock market or cryptocurrency, that could drop in half or to zero. You really can't do that in real estate. It could drop down to what you put into it because you still have the land underneath it. 2, a mortgage company is not going to give you a loan without home insurance, especially something that burns to the ground. So, you actually have money to rebuild the house, and you're just out some rental income. But typically the insurance will also cover the rental income until the house is built. And so you have just safety net after safety net. So low risk, but people are scared because the stories that make the headlines are the foreclosure stories. It's the doom and gloom. And it's those people that typically have, they get in trouble, have variable interest rates on a mortgage. So instead of a 30-year fix, which just means your expenses are not going to change, the ones that get in trouble have ARMs, adjustable rate mortgages. It'll be 3% mortgage rate for 3 years, and then the 4th year jumps up to 7% or 8%, and they just didn't budget accordingly. And that's when you get caught. That's when you get, really sort of in a dangerous situation. And you specifically said you only recommend 30-year mortgages, and I 100% agree with that.
Yeah, exactly. Just one caveat: if the house burns down 15 minutes after you buy it, you may be investigated for insurance fraud. So I wouldn't recommend that route. But yeah, if in a full loss situation, that's what your home insurance is for. So you'd be paid out in that sort of a situation. But yeah, the point about lending and the different sorts of lending products is really important, because I think a lot of people, when they're starting out, and to your point, they read these stories about, people who've lost their shirts in real estate investing. That's typically with aggressive or creative financing that either has a balloon payment at some point, right, where the full amount balance of the loan comes due, or like you said, it's got an adjustable rate. And those things introduce a lot of risk into what you're doing. A 30-year fixed mortgage on a house that you're renting out, that's, to me, one of the lowest risk ways you can invest money, even as compared to the stock market. Stock market's going to be good in the long run, probably. But in the short run, it's got a lot of variation, as we've seen in the last, week, right? It's down 10% in the last week, it may go down further, right? So, the 30-year fixed, it's a boring, conservative way to invest. And that's the way I personally like it.
Yeah, I do too. I I did get creative financing to purchase my portfolio of single family homes, but it wasn't scary. It was seller financed. And so what this means is basically this seller had his portfolio at the time was 30 homes on the market, and he couldn't find a buyer. I think part of it was marketed really poorly. It had actually every home listed for $30,000 each. But when you click onto the link, he had 30 homes, $30,000 each. So it attracted a lot of people who were just looking for $30,000 homes. But you click in, and it's like you have to buy the whole package. And I want to say the whole package ended up being like $1.1 million. So that eliminated a lot of people. It was also sort of difficult economy-wise at the time. A lot of banks weren't giving out single family home options. I know now a lot of hard money lenders are doing this. Specifically because Wall Street and some of these hedge funds are really getting into single family. So that sort of brought in a bunch of different hard money lenders in this space. But I didn't have any financing options at the time. And so I reached out to him and I said, listen, I'll buy this property, but would you be willing to seller finance? He was, because he tried to sell this for 6 months, no bites. And he knew the only way he could sort of, I was the buyer for him. And so we agreed 10% down. And it was a 7% interest rate for 15 years, fixed. So interest rate was high, 7%. That would have been high for the last 15 years. That's a high interest rate. 15 years, that's shorter than a 30-year. So the payments are a little bit higher. I put it in a spreadsheet, and I was still cash flowing, and I only had to put 10% of my own money in. So imagine buying, we were talking about people who save up $100,000 cash. They want to buy one house for $100,000. I was able to buy 30 of them for $100,000. And that's leverage. That's instant scale. He already had a property manager that was built in, down to 8% because there were so many properties. And then that property manager brought me another 20 over the next 2 years. And so that's, you could get creative financing, and I'm going to get questions and comments. Okay, I want to buy a home. That's seller financing. It's not really advertised. It's just, you get lucky when you start making phone calls and you try making deals work and say, hey, I love it, but I can't get financing. Can you do this? Something that's been on the market for 6 months. You can get creative, but avoid the arms that I said. Avoid the balloons that Eric's talking about. Because those are where you get caught. That's sort of to iterate the balloon. The balloon is you have 2 years, then you have to pay off this loan. So most people can't come up with the 80% different in 2 years. What it's really saying is you have to refinance into another mortgage that's not this bank within 2 years. And sometimes that can be difficult, or people forget about it, or they run out of time. And so that balloon payment can really get you, as well as an adjustable rate mortgage. So just financing is a tool. I say this all the time. If you're going to be real estate investing, it's understanding the tools in your tool belt, and financing, and multiple different types of financing, and just understanding what your options are out there are really going to help you push this and get farther. I'm curious. So outside of Memphis, what are some of the other towns that some of your clients are investing in, if you're able to disclose that?
Yeah, sure. So Birmingham, Alabama is another very popular cash flow market. Pretty similar to Memphis, but just a little smaller in size. Cleveland, Ohio is another very popular one. Had a few clients shopping there. St. Louis also tends to jump to the top of the list. But then I've got a few others sprinkled in other places. Cincinnati, Pittsburgh.
And if we get a lot of viewers from the Atlanta area, and that's where I'm based. If you're looking for something 2 to 4 hours from Atlanta, you can hit these same numbers that Eric puts on his blog on Rental Income Advisors that he gets in Memphis. You can hit those in Albany, Georgia, Augusta, Georgia, Macon, Georgia, Griffin, Georgia. These are all sort of small towns, but significant enough that they're going to have jobs there. They're not decreasing. They're just stabilized small towns. Not a lot of people moving in, but not a lot of people moving out. So you have these lifelong tenants that want to stay for a long time. We've covered a lot of ground here. What's that?
Oh, I was just going to mention one thing. Yeah, Augusta is a great market. I think that's something that was in my article. The smaller markets, the only thing to watch out for in smaller markets is just the availability of property management in particular. So the smaller the market is, right, the velocity is lower. There's just less activity rental and sales wise, but then there's also not going to be big property managers, right? And for me, I recommend to people, all of the things being equal, you want a large PM, right? Because they've got systems and processes and automation, and that's really what you want. You don't want a friendly voice on the phone. You want Amazon, right? You efficiency and things that are automated. So my property manager has 3,500 homes that they manage. So there's no way to do that without reliable systems. And, in your case, you've had a slightly different situation that's also worked out well. But yeah, no matter if you want to invest in a smaller market near your home, you can definitely get the numbers. The question is, can you get the support?
I love that. I love that. The way I vet property managers, I've learned this through trial and error. If they're doing their numbers each month in like an email or even in an Excel sheet, they're probably not qualified to be property managers. There's so many solid property management software programs out there that do the background checks, that have a portal for the landlords to log into. If your property manager is not using that, they're probably not the type you want to use, or they're probably retiring you soon, and you're going to have to find a replacement because it's usually the old timers who don't want to learn a new system. And so they've got a short shelf life to be your property managers at the same time.
Yeah, I agree.
So outside of this, I'm trying to think of any sort of worries. Again, if you're watching this on YouTube or Discord or Twitch or on the House of AC Facebook page, ask all your questions. Eric is the man here. So bring in your questions. Let's get them answered so that you're comfortable doing long distance real estate investing, especially in properties under $100,000. But maybe that's the question, Eric. Does it have to be this cheap of a property? Could the same model work at more expensive homes?
So basically what generally happens, right? General rule of thumb is that as you move, let's say within a market like Memphis, from less desirable neighborhoods to more desirable neighborhoods, the prices go up, right? The rents also go up, but they don't go up as fast on a percentage basis. So as you get into higher and higher priced homes, that 1% rule that you talked about, right? It's gonna get lower and lower and get harder and harder to get the same ratio. So, it can work if you get into, say, $120,000 home or even $140,000 home. You can get close to 1%. You can get close to your 10% cash on cash. If you get into $180,000 or $200,000 home in Memphis, you won't. It's basically impossible. So, it doesn't have to be $80,000 or $70,000. It can be more, but it can't be $250,000, right? No house anywhere in the country at $250,000 is going to be a strong cash flow property.
I agree with that. And I'm showing on the screen here your website. So please, guys, check out Rental Income Advisors if this is something you're interested in. There is some parallels to this, and the piggybacks off the question I just asked, in that vacation rentals. A lot of people start there as they're towing into, because it's long distance, right? They're investing in vacation property, and it's property managed by a third party. And that's sort of the difference of the price point. To me, that's not a $250,000 purchase. It can be, but you're going to more expensive homes. And do you have any clients that do that? Do you recommend that, or how do you advise people who that like that because they can visualize themselves in the home?
Yeah, I get the question a lot from prospective clients. My point of view, I don't do it. I'm not an expert in vacation rentals, so I can't represent, that I know everything about it. But I've spent some time running numbers and looking at some examples that clients have brought to me. And it can be okay as an investment, but it's not going to get the same total returns that you're going to get, through, my homes in Memphis, for example. So I tell people, look, if you want a vacation home and then you want to get some extra money from renting it, great. But if you're just looking purely from an investment standpoint, it's really unlikely that vacation rentals are going to be, maxing your returns.
And the way I look at it too is someone's always going to need a place to live 12 months out of the year. Not everyone needs need to go on vacation. The pandemic definitely shortened a lot of vacations or canceled a lot of vacations in recent years. And also there's town laws and municipalities that are preventing Airbnbs from being even rented out without a hotel license. So even if you already own some, those rules could change. So there's a little bit more risk there. Not saying you can't make money off of it. Everyone likes to come back telling me how much money they make off the vacation rental. Not saying that you can't make good money on it. This is a different product. It's a little bit riskier. The way I like to look at it is do Eric's method, the long distance real estate investing in single family homes that are cheaper. And then you have enough cash flow. And let's just say that cash flow is $1,000 a month, $2,000 a month. That would be enough to cover the mortgage possibly on a great vacation rental. And so then you're sort of balancing the risk and reward. You do get that vacation rental, but it's propped up by a sturdier, less risky investment. And then that way, if there is a down period in the vacations period, or the rules change, or you don't like being a vacation rental, you can try to swap it out.
Yeah.
This happens a lot to me is, people want to get in real estate invested, and to them, it's a bit of a vanity, kind of like, they want to drive a Lamborghini and show their friends. And when I show them properties that they should buy because it'll make them $400 a month, they're like, well, I can't drive my parents by that home and point out and say I'm the landlord of that. Do you ever get those sort of questions and concerns?
Yeah, a little bit. I mean, there's nothing glamorous about my rental portfolio. It's, it just, that's not the purpose that it's serving. What to me is glamorous, right, is that I quit my job and now I've got a lot of control over my time and my choices, and was able to start a website and a business venture and buy this place in Florida and play golf during the week. That's what's glamorous. The homes themselves are, it's not a vanity asset, that I'm going to show off and have people be impressed. They're $100,000 homes in Memphis. They ain't special.
I love that you said that. You just sort of made it all very clear for me. Like, the glamour is in your freedom and your time freedom. That, how glamorous is your day job, right? Whoever's listening to this, imagine saying, I don't have to be at my day job because I bought 20 unglamorous properties. Like that's your Lamborghini that you're showing off is, I'm able to golf every day and, live wherever I want. And you don't have to clock into a 9 to 5. So I love how you switched that there. I think that's the smart way to looking at it. That's the trophy that you're holding up that you get to brag about. If you need something like that, you need some sort of validation from your family or friends if you're doing the right thing. And nothing feels better than getting to the point where you look at how much you're making in your day job and after taxes and all the money that goes into your account, and you've over 2, 3, 4 years, you have the exact same amount of money from 5 to 6 single family homes that you bought, one a year kind of thing. And you're like, wait a minute, why am I even working at my day job? If I just focus on the rentals, then that'll be faster than getting a raise at work. And maybe that's a question to you. How, when someone buys their first property, do you have a waiting period for them to buy their second one? Or how do you sort of coach them through, hey, let's go around this carousel again?
Yeah, no waiting period. A typical client I spend a couple months with before they start making offers, just to sort of set the table with their strategy and their understanding of what they're going to be doing. But from there, as long as they've got capital to invest, they can go as quickly as you want. And again, I'm a fan of getting to scale quickly, because I think I mentioned earlier, one of the biggest, existential risks is that people draw conclusions from too small a data set and give up on the endeavor, right?
Right.
I think, that's what I really want to get people over, right? Because you only get the real benefits of this model once you get to scale. You can't replace your W-2 income with 2 or 3 properties like that. It's not enough, no matter what your income is. So, if people have capital, a lot of times they're moving forward multiple properties at once and just trying to get to scale.
So we've got a question from YouTube. One of our YouTube viewers, Jasmine, says, so ultimately, I think this is addressed to you, Eric, you'd recommend purchasing multiple lower cost investments rather than spending more on a better area, nicer units if you're just starting out.
I mean, I would, because I'm an advocate of using the dollars you invest to generate cash. So buying those lower priced homes is what's going to allow you to do that, right? So again, think this metric that I mentioned earlier, cash on cash returns. So that's used a lot by real estate investors. It's essentially a yield, right? If you know stock investing, right, it's the same thing, right? If I invest $100,000 of my money into something, how much cash is it going to give me? If it gives me on average $10,000 a year, that's 10% cash on cash returns. So if I took my $100,000 and invested it in the types of lower priced homes that we've been talking about, I can get that 10% plus rate of return. If I focus on a better area or a nicer area, that's going to be a higher priced home, and I'm not going to get 10%. Maybe I only get 6% or less. And for me, right, my main goal is to dial that cash on cash returns as high as I can. That's it, right? So I'm not worried about if it's in a nice area necessarily. I want to be able to rent it, of course, but again, most people's perceptions of what a rentable home is are much too high based on their own personal living experience. And so I don't want a nicer home in a nicer area. I don't care if it's appreciate or if it's, those things are not really important. For me, it's just about the cash on cash dial and getting it as high as I can.
And so outside of the cash and cash return, I just want to talk about appreciation. We know that these properties are not expected to appreciate, which means just go up in value wildly like they would in maybe a really desirable town or something where, Elon Musk is starting a new company in a new town and there's going to be 1 million of jobs and all the prices double or triple. But let's just assume, like on average, the housing stock, the prices of homes on average historically go up about 3% every single year, more or less. So if you're buying one expensive property, Jasmine, let's call it, let's just say it's $100,000. You have $100,000 cash and you buy a $100,000 property. In 3, 4, 5 years, that one property that you bought in all cash is $110,000 now. Maybe inflation helped with that, but you've got an extra $10,000 of equity in that home just from housing going up in price. But now imagine you took that $100,000 and you chopped it up and bought 5 homes with that, 20,000, 20,000, 20,000, 20,000. And then they're all 5 different $100,000 homes. So one, you hit the metric Eric just said, your cash on cash is going to be through the roof, much better investment for you. But 2, let's assume the price of the housing, you did nothing, but housing went up $10,000. In the first example, that $100,000 house is now worth 110. You made $10,000 on appreciation just for buying and holding. In the second example, with 5 homes, you have 5 homes that were $100,000 that are now $110,000. You just made $50,000 by buying and holding. So you made more money cash each month, Eric's metric, and then you made 5 times as much money in equity just by being a long-term holder. So this is not a flipping business or anything like that. And then on top of that, there's, you're probably increasing rents a little bit each month too. I always recommend that just because, there's landlord expenses are going to go up. Tenants expect you to go up, their lease to go up. So your cash flow is going to go up a little bit more each month. So it's just one of those games where the more you buy, the more often you buy, and the longer you hold, it just gets better and better, sweeter and sweeter. And then you get to live the life that Eric preaches, kind of leaving the day job and doing this full time. It's really fun. So thank you, Eric. Any last words, any sort of anything maybe we left out for that first time real estate investor or maybe someone who's just towing the water, into looking outside their market just because it's a little bit cheaper and they get better returns? Anything you would suggest there?
Yeah, and I think we covered a lot of ground. There's a lot more in addition to the
Okay, well, Eric, you're sorry, we're losing you a little bit. I'll give you a second. Let me get your Wi-Fi back up. But I'm showing your website, Rental Income Advisors. This is Eric's website. Can you rephrase what you just said one more time?
Yeah, sorry about There's other content on the blog in addition to those portfolio updates that is really good for new investors. So, how everybody can check that out. So whether you're
Yes.
questions about LLC or taxes or, it covers a lot of ground. So it's a good resource for folks.
That's right. So check out his blog. That's what he's saying. Every month, he tells you exactly how much money he made or how much money he lost and what he bought, what repairs he did, what the property manager interactions are. All that is on his website. Very, very informative. So you can kind of peek into your future. Just this can be your future. It's very, very achievable. If you just want to be Eric or me in 5 years, just go to this website and say, wow, this is my goal. This is my plan. You know what to work towards. I want, what was this? You had in December, 20 doors, 19 occupied. You charged $19,220 in rent. You collected $17,927 after paying. So your total expenses were $12,000, $9,000 and change going to mortgage, $2,000 property management, $845 maintenance, $465 utilities. If you're just listening on a podcast, guys, at the House of AC podcast, this is all online. Just go to rentalincomeadvisors.com. But he does it. The bottom line is 1 month right now, you're making a profit. At least in December, you made a profit of $5,000, which is slightly below your average, it looks like. If everyone paid on time, if there wasn't any vacancies, you make $6,000. So imagine doing this over the next 5 years, buying one property a year for 5 years. And, what will happen is you may take your first property takes you 3 months, 6 months, your second property, 3-6 months after that. Really, you can get up to this and really replace your day job income. So I love it. And thank you so much for being a guest on the House of AC live stream. We live stream daily here. Follow me along. Please leave a comment and thumbs up wherever you're watching. Retweet. Tell your friends. All I do this is for your likes. Happy to help you. And thank you to our sponsor, Jasmine Team. Jasmine Home Lending will help you get mortgages on these properties. So just go to jasmineteam.com. And Eric, will you come back on the show?
I will. I'll be happy to. A lot of fun.
All right. Well, I don't want to interrupt your golf lessons or golf playing, so I'll make sure to give you plenty of notice. So thank you so much for sharing your wisdom and helping others out there achieve the house fire dream that I teach as well. And you've always been very supportive of what I'm doing. So thank you very much. And I love following what your real estate career is doing as well. So keep at it and keep up the good work.
Thanks, Alan.
Sure. All right.